The last time the OBR put out this annual publication, its projection was that essentially on unchanged policies over the long run, and assuming that the government continues to pay pensions and fund the NHS in line with both changes in demographics and changes in the demand for health, and indeed other components of government expenditure, but kept taxes as they were. The central forecast was that the stock of debt relative to GDP 50 years from now won't be 100%, not even 120 or 140%, but not far off 300% of GDP.
Hello and welcome to the IFS Zooms In. I'm Paul Johnson, Director of the Institute for Fiscal Studies, and today we're going to be talking about government debt. It's often in the headlines, not surprisingly, given that currently the government owes around more than £2.5 trillion. That's nearly equal to 100% of UK GDP. That's the value of all the goods and services produced in the UK in a year. How has that debt level grown? Do we need to reduce the debt? Do we need to worry about it? Are high debt to GDP ratios a problem? Can we afford to borrow more? Well, these are actually pretty fundamental questions when it comes to the future of economic and fiscal policy, and indeed the future of politics in this country. So it really, really matters whether we think that is a problem or not. It really will determine, actually, or the view of the next Chancellor will determine very substantially what they do over the next 5 years. So I'm delighted to say that joining me today to answer all of those questions and more is David Miles. He's Professor of Financial Economics at Imperial College Business School. He's a member of the OBR Budget Responsibility Committee and a former member of the Monetary Policy Committee at the Bank of England. So there is probably nobody better qualified to talk about this topic. So, welcome, David.
Welcome. Thank you very much for having me.
Perhaps you could, let's just start with what is government debt? How much of it is there? How is it different from personal debt, corporate debt? What is it?
Well, it's an IOU, essentially, written by the government and sold in the financial markets to whoever wants to buy it. It is a promise to pay with interest the money back at some point in the future. Some of it will be paid back in the very near term. Governments issue some debt that will last for 2 or 3 or 4 years, but they also issue, particularly in the UK, longer term debt as well, which is an IOU which promises to repay the original amount of money as much as 50 or 60 years into the future, and along the way between now and then pay some interest called coupons, but essentially you can think of that as the interest on the debt. Governments in the UK have been doing it for at least 300 years, nearer 350 odd years, and they're doing it on a very large scale at the moment because as you rightly say, that the amount of that debt that is outstanding right now is about the same size as annual GDP, and that's a lot higher than it was just a couple of decades ago.
And it's about the highest, I think I'm right in saying, that it's been since the early 1960s.
That's right. I mean, it was much higher as we came out of the Second World War, but actually that stock of debt was reduced very substantially and got down to only 1 year's worth of GDP, having been 2.5 years worth of GDP or thereabouts at the end of the Second World War. We haven't been involved in a major world war, thank goodness, since the 1960s, or since 1945, in fact. And that stock of debt for most of the last 50 or 60 years has been considerably lower than it is right now.
Should we take any comfort from the fact that it took us less than 20, I mean, as you say, 1945 debt was whatever it was, 250% of national income. By 1965, it was below where it is now. Ergo, no problem.
I think that would be slightly more optimistic than is warranted.
Very, very, very nicely put.
For a few reasons. I mean, the main one was, as people were fully aware, the level of government expenditure during the Second World War, just as it had been in the UK during the First World War, was extraordinarily high. A substantial proportion of the population was involved in one way or another in war-related work, most obviously in the military. At the end of the Second World War, that level of military expenditure fell back very substantially quite quickly. And a very large number of people who'd been in the military then rejoined the civilian workforce, started paying income tax. And so government spending could come down quite rapidly, particularly because the military element of it just came down fast. GDP rose reasonably steadily for the next few decades. And the number of people paying significant amounts of tax increased. And that combination of events really brought the debt down in a way that you couldn't bank on happening right now. I mean, military expenditure now is 2% of GDP, and an intention, it's not exactly a sort of cast iron commitment, but an intention that it might actually go up rather than fall back dramatically as it did in the years after 1945.
And indeed, if you look around government spending, it's pretty hard to see the bit of government spending that's going to come down significantly over the next 5, 10, 20 years, whether that's on pensions or welfare, education, health, justice. I can't easily see a big chunk of government spending which is going to come down in the way that defence spending came down in the decades after the last war.
I think it's going to be difficult, and it would need perhaps a change in the expectations of the voting public about the role of the state to reduce government spending as a percentage of GDP as much as it came down after the Second World War. And maybe we'll come on to a bit later. I mean, in a sense, there's a difficulty now because I think people's expectations of what the state will do are very different from what they were at the end of the Second World War, and maybe haven't adjusted to the economic reality of the rather bad economic performance for the UK, not just the UK, but certainly including the UK over the last 10, 15 years or so.
So, well, let's come on to a bit more spending in a minute. We've established that debt's high by historic standards, highest it's been for 60 odd years. How does it look by international standards?
I think it's probably about middle of the pack amongst richer developed countries. It doesn't look unusually high relative to most European countries. It looks high relative to the US, but I'd say right now it's probably about in the middle of the pack of developed economies, and absolutely in the middle of the pack relative to our closest geographic neighbours in Europe.
And particularly relative, I mean, the G7, the biggest ones, we're about in the middle, aren't we? We're not.
That's
we're
about
not
right.
An outlier.
Yeah.
So how much should we worry about this? So we establish it's high, but it's not the highest among comparative nations. Some countries have more debt than we do. Some have less. If you're a government wanting to spend more, borrow more, because you don't really want to tax, that'll increase our debt somewhat. But given it won't take us above Italy, say, in the near future, why are people like you and I worried about this?
Well, it's all very well being in the same boat as everybody else, but if the boat's leaky and it's in danger on a stormy sea, that's not terribly helpful. I don't want to sound sort of uber pessimistic, but I think there's a debt issue, not just for the UK. I mean, as you rightly say, there are plenty of other economies comparable to the UK in Europe and beyond who also have a high level of debt and higher than they have had in the past. And I think there's a fiscal challenge which goes way beyond the UK. So we're kind of in the same boat, but that doesn't mean the boat's
it's a leaky
in a great
boat.
place.
We're in a leaky boat.
Yeah, it's a boat that's in sort of choppy waters, and it's maybe riding a bit low in the water.
And one of the problems for us is that, I mean, obviously, if you've got a lot of debt, you have to pay interest on it, and then you have to pay it back. At the moment, we're paying a lot of interest. partly because some of our debt is inflation linked, and obviously inflation has been quite high, partly because quite a lot of our debt is held by the Bank of England. And to some extent, I mean, some of the chickens, I mean, to mix metaphors horribly, the chickens are on the boat now, but possibly going down with it. But some of the chickens have come home to roost in terms of the level of borrowing we've done over recent decades, in the sense that we're spending more on debt interest than we have in a very, very long time. And of course, that is squeezing out the possibility of spending on other things.
It's true that government debt interest spending relative to GDP, relative to government revenue as well, has risen a lot. And that's not surprising that's happened. If you go back just a couple of years, a lot of UK government debt had an effective interest rate or yield which was barely positive, 1%, or as low as that, it's now nearer 4%. If you did that in inflation-adjusted terms and looked at the yield on that bit of UK government debt, which is inflation-proof, index-linked debt, remarkably, as recently as 2.5 years or so, the UK government was able to sell debt, and it was trading in the market at an inflation-adjusted interest rate. 10-year UK government inflation-proof debt was trading at a real interest rate, real yield of close to -3%.
That's astonishing. People willing to buy British debt and make a 3% a year real loss on it.
Yes, and in a sense, if you do that and you buy a 10-year government bond, you're kind of locking in on an investment which 10 years later will have lost 30% of its value. And that was being willingly held in the financial markets. It wasn't like governments forcing people to buy this stuff. That was the price at which it was trading. And you could look back on that now and say, well, that was a fool's paradise, wasn't it? That couldn't possibly last. Although there were plenty of smart people who say, well, of course, the world is different now than it used to be, and demographics are different, and all kinds of arguments as to why such extraordinarily low interest rates were what you'd expect into the future. In fact, the government yield curve is quite a good way of assessing what hard-bitten, self-interested, sharp-minded investors in the financial markets think is going to happen to interest rates in the future. And they did not predict that interest rates would rise as much as they have relative to 3 years ago. So that -3% number, the real interest rate on index-linked debt, has now become a positive number, about +0.5%. That's a huge swing. The debt that's not index-linked, sometimes called nominal or conventional debt, that had an interest rate of about 1% or so. That's now gone up to about 4 and a bit percent. Again, 10-year interest rate. So both the nominal and the real have gone up by 300 basis points. And when you've got a stock of debt that's not far off 100% of GDP, that means the interest bill is 3% of GDP, ultimately will become 3% of GDP higher. And that's not far off £80 billion or so.
And it's worth saying £80 billion is more than we spent on any public service other than the National Health Service, which is a pretty substantial chunk out of government revenue.
It is indeed. Now, some people are optimistic that what has happened over the last few years is a reflection of a spike in inflation, and that might roll through, and that the Bank of England is, as it seems likely in the near term, bring interest rates down a bit, and maybe we go back part of the way to where we were 3 years ago. But I think that's perhaps, again, to rely on that is not the most sensible strategy, because while it's true that so-called nominal interest rates you might expect to go up because inflation's gone up, those index-linked bond yields, which have gone up every bit as much as the nominal interest rates, are adjusted for inflation. So something's happened that's not just a short-term reaction to inflation recently having moved up to high levels.
And it is worth saying that we are now just at something which is more close to normal. I mean, the period from 2010 to a couple of years ago was unique in history in terms of the how low interest rates were. Bank of England base rate was the lowest it had ever been. The interest rates on the government debt, the lowest they'd ever been.
Yeah, exactly. Which is why I think that any idea that we're going to go back to where we were a few years ago given the different economic environment we're now in, seems somewhat misplaced.
Well, I have to say, I think that's a good thing from many reasons.
Oh, indeed,
Not
indeed.
from the point of view of public finances,
Indeed,
perhaps, but
indeed.
for pretty much every other reason. But we could perhaps discuss that on another occasion. You've mentioned the Bank of England a couple of times. I mean, one thing that I think we probably have to spend a moment or two on is the quantitative easing programme and the debt effectively held by the Bank of England. I don't think there is a talk that I give when I'm talking about debts and deficits and so on, when someone doesn't pop up their hand and quite reasonably say, well, look, a whole bunch of this debt isn't real. It's held by the Bank of England. The Bank of England is in the public sector. Why on earth are we paying interest on this? Isn't this just some strange financial transaction that in some sense isn't real, and hence the actual debt stock is hundreds of billions less than the number we've been talking about?
Well, the bank is on following a strategy now, as in many other central banks, the ECB, the Fed, in the US, of actually running that stock down. So even if you took the view that it was kind of free money, the strategy of the Bank of England is to sell it off. I don't think it's free money even if the Bank of England held it, because the interest rate that is being paid on essentially the funding for that debt is the Bank of England's own bank rate. Now, you could say, well, why don't they just stop paying Bank of England bank rate on the funding that's held by the private sector through banks at the Bank of England, which is essentially financing the Bank of England's ownership of the UK government bond debt, or the gilts. But if you decided not to pay interest on the private sector assets, which are the liabilities of the Bank of England, I mean, you could describe that as either deciding to penalise people who hold money in the Bank of England, which you could try and do, but they would withdraw the money. So the reserves of the banking sector, which is really the liabilities of the private sector held at the Bank of England that funds the ownership of the gilts, unless you force the banks to hold such a large quantity of reserves, if you decided that we're simply not going to pay interest on them and save the UK taxpayers, rationally those banks, acting on behalf of both their shareholders and you and I who may have deposits with those banks, would pull their money out and invest it in things that did pay interest. So then you say, well, okay, maybe the Bank of England should just force the banks to hold deposits at the central bank paying no interest, and you just make that a rule. You can't be a bank if you don't do that. Well, you could do that, but what you've then effectively done is you've taxed the banking system and you've financed government public sector debt by essentially taxing the banking sector. Now, you could do that. And then the question is, well, is that an effective tax? Is that an efficient tax? Somebody's paying it, and it may end up partly being paid by the shareholders of the banks. And some people may say, well, fine, they're rich, who cares? Well, they're not rich because it's in pension funds and life insurance companies as much as it is in the hands of people who own hedge funds. But actually, a significant part of the cost would, I think, fall upon the customers of the banks. There's the customers of the retail banks in the UK, and they pay less on deposits and they charge more on loans. So there's no free lunch here.
Perhaps it's worth just going back one step on that no free lunch thing. Why is it that, what is the link between the Bank of England buying government debt and this return that the private sector banks are getting? I think that's the link in the chain that I think people often find a little bit difficult to comprehend.
Well, when under the QE operations, the Bank of England was buying debt from the private sector. It wasn't buying it from the government directly. It was going into the financial markets and buying existing government bonds that had been issued in the past. And it had to pay for them in some way. And essentially, you could think of it almost as the Bank of England writing a cheque to whoever it was that wanted to sell the gilts to the Bank of England. And that could have been a UK pension fund, an insurance company, it could have been a sovereign wealth fund, a Norwegian wealth fund, it could have been investors in California. But whoever they were essentially being paid with a cheque from the Bank of England, which they then cashed with their bank. So it could have been a UK bank. If it's a UK pension fund, it might have been Lloyds. Lloyds then present that cheque at the Bank of England, and the account of Lloyds at the Bank of England is credited with the money. When you cut through it all, what's really happened here, the economics of it, are that the widely defined public sector in the UK, so that's the government and its wholly owned nationalised entity called the Bank of England, has decided to enter into a switch of the funding of UK government debt from gilts that might pay interest rates linked to 20, 30, 40-year interest rates, and switched it into short-term debt that pays the Bank of England bank rate. And when you view it as a debt management portfolio switch, with the government deciding to issue and fund itself less by long-term debt and more by short-term debt, all of which pays interest, then some of the sort of magic of it disappears, and the idea that there's some kind of magic way of improving the fiscal situation of the government dramatically just because of that also kind of evaporates in front of your eyes.
I think it's really helpful because I think that's, as I say, something that is always in the back of some people's mind. And I think the answer, as ever, is if it seems too good to be true, it is too good to be true. And there really isn't such a thing as free money in any of this. We could probably spend the whole time talking about QE operations and how they work. We should probably move on. So we've established that there's a lot of debt, that we're paying a lot of interest on it. One of the challenges going forward is that, unless there's some big change in people's views about what they want the state to do, it's unlikely that that spending is going to go down very much. But the other parts of this puzzle are that once you've got debt at a high level, once you're paying quite a lot of interest on it, and when you've got low growth, it's really quite hard to get that debt pile down, isn't it?
It is, and there's a sort of well-known relationship between the ease with which a government can reduce its stock of debt and the relative magnitudes of the interest rate on that debt and the likely growth of the economy, GDP growth. And what's happened in recent years, certainly in the last few years, is an increase in the interest rate, the R bit of the balance between R and G, R the interest rate on the debt, G the rate of growth of GDP. The R bit has gone up quite a lot, and the G bit, the growth of GDP, hasn't gone up as much, but maybe hasn't gone up much at all. The OBR's latest forecast is that the rate of growth of GDP on their central forecast anyway, I mean, thankfully is positive. I mean, it's not a negative number.
Hurrah!
It's probably somewhere between, a bit above 1.5%, maybe a little bit under 2%. The central forecast is that, if you like, the cruising speed of the UK economy is that GDP might grow by something around about 1.7%.
To put that in context, that's pretty poor relative to the pre-2008 period. It's actually not too bad relative to the period since 2010.
That's right. And some people accuse the OBR of having a sort of excessively optimistic central forecast that we could get growth consistently at a rate of 1.5% to 2%. But as you say, it's also rather materially lower than the average rate of growth in the decades leading up to the financial crisis, which was, a bit north of 2.5%, and that difference, particularly over the long run, is very material.
Makes a huge difference, absolutely. So, what about this other issue around debt? And I think this is one of the kind of big political questions again, which is if we spend more now, particularly on high value investments, which will get the economy growing. That will, in the long run, more than pay for itself. And therefore, actually investing now, increasing the debt, is a good investment because it's the only real way that we're actually, slightly counterintuitively, going to get debt down in the longer run. And the argument goes, this focus, this it's excessive focus on the fiscal situation is actually one of the things that's held us back. We should have been less concerned about the debt, more focused on high value investment, and given where we are at the moment, we should be reasonably unworried about the debt rising over a period into the future if we're using that money to invest for the longer term future.
Well, in principle, there's nothing wrong with that argument at all. I mean, if one can be confident that the rate of return on average over a long period into the future of major elements of government spending, capital spending, is significantly positive and significantly in excess of the interest rate on the debt that you issue, then indeed that can make the situation better and can ultimately make the stock of debt more affordable and sustainable. There's nothing wrong with that argument at all. I think it needs to be seen, though, in the context of not so much a level of debt that today is 100% of GDP, but where that stock might go in the future and how much potentially high rates of return on public sector investment would need to offset what might otherwise be an underlying upward trend. So the OBR, as well as doing forecasts over the next 4 or 5 years, which are very relevant to whether the government will hit its fiscal targets, does produce once a year an assessment of the longer term fiscal outlook going 50 years out into the future. And last July, which was the last time the OBR put out this annual publication, its projection was that essentially on unchanged policies over the long run, and assuming that the government continues to pay pensions and fund the NHS in line with both changes in demographics and changes in the demand for health, and indeed other components of government expenditure, but kept taxes as they were, the central forecast was that the stock of debt relative to GDP 50 years from now won't be 100%, not even 120 or 140%, but not far off 300% of GDP. So that's the scale of the longer term fiscal problem. And whilst it would undoubtedly be eased if there were very large scale government investment projects that yielded returns significantly in excess of the interest rate, the idea that that in itself can solve the problem seems to me, somewhat optimistic.
So just let me try and unpack that. So you're saying that the argument for borrowing to invest at the moment, if you can be reasonably confident you're going to get a good return on it, is sound.
Yes.
We're in the context, though, of a world in which if we don't do stuff, debt will just carry on upwards. I'm struggling with why that second part is an argument against the first part.
I don't think it was an argument against the first part. It was rather the observation that whilst significant public sector investment at a high yield which exceeds the rate of return is helpful, it would need to be on an enormous scale to offset what is otherwise a trajectory where government spending, given demographic change, faces lots of upward pressure, and some sources of tax revenue might actually be going in the other direction. Just to give one example, taxes, excuse me, taxes on fuel duty, because of the switch toward electric vehicles, we could argue how rapid that switch is happening, but that switch is likely to reduce some forms of tax revenue by non-trivial amounts. So a combination of rising demands upon the state, and if you leave the tax system where it is, at best a kind of steady but possibly declining ratio of tax to GDP, generates a hole if you don't do something about it, which is so big that the idea that there is a huge collection of highly profitable investments that the public sector could undertake that can fill that hole seems to me somewhat optimistic.
Again, a wonderful understatement. I get your I get your argument. So, all else equal, there is a case for investing, for borrowing to invest in the short run, but that's not going to offset the long-term fiscal issues that we're talking about. So, whilst it may well be sensible to borrow to invest now, there's just no getting around, I think, in your mind, this inevitable choice between finding some way of cutting spending relative to what it otherwise would have been, or finding some way to increase taxes. Investing now more might actually help a bit, but that fundamental sort of fiscal constraint is going to bite. And even if you could find some really high quality investment, which is going to make us quite a lot better off than we otherwise would be in the future. And let's remember, not all government investments do that. 70 billion quid on HS2 might not achieve that in terms of railway to Birmingham from London. But even if all of it was that good, that just doesn't get us away from this fact that we need to deal with the fact that our debt is high.
I think that's exactly right. Now, I mean, it wouldn't take an enormous, sustained increase in the rate of growth of productivity in the UK to make the situation very dramatically better when you look 50 years down the road. But there you run into the following big issue. Over the last 15 years or so in the UK, productivity growth has been very disappointing by historical standards. That's not unique to the UK, but it's been pretty significant in the UK. And by disappointing, what I mean is that productivity growth for the last 15 years, since the financial crisis, in fact, has been barely positive, maybe a bit more than 0.5%. The 50 odd years before that, productivity growth, that's output per hour worked, was nearer 2 and a bit percent. The OBR is actually at the somewhat optimistic end in its forecast about where that productivity growth might go, thinking it might pick up to slightly closer to 1%. If we were to see a return to the 2% odd level, and it stayed there for the next 50 years.
Happy days.
They would indeed be happy days, and we would most certainly not be looking at the stock of debt to GDP of 300%. It would be very dramatically lower than that. The difficulty here is that no one really has a particularly reliable model of what's going to happen to productivity growth. And in some ways, there's a good reason for that, because to a large extent, productivity growth is driven by inventing new things that you don't yet know about. So predicting
loads of new things. What about AI? What about
there's
the
the
internet and all this kind of stuff?
There are indeed the optimists on AI. I would note, however, that the person who has written most, and probably with most insight into the macroeconomic effects of AI, is Darren Acemoglu of MIT. And Darren has just written yet another long, very carefully calibrated paper on the economics of what AI might do to GDP. And I have to say it's somewhat pessimistic, by which I mean that his central estimate is that over a 10-year horizon, if I remember the numbers correctly, he presented this paper about 4 or 5 days ago, the end of last week. His projection was that his central estimate was that over a 10-year horizon, AI in the US, this is, would increase the level of GDP over 10 years by 1% relative to what it might have been. In other words, 1/10 of 1% roughly increase in productivity.
I does wonder why all these very clever people bothered with inventing it in the first place.
Yes. Now, I'm not saying that Darren Acemoglu is the only person worth listening to this, but he's a smart guy. And I take sort of rather seriously some of the things he says. I have to say also that one of the reasons why the OBR is at the somewhat optimistic end in its central forecast.
Just remember, this is David. David here is Mr. Cheerful.
Yes,
you might not have noticed that from
relative to me, Mr. Cheerful. One of the reasons for being sort of slightly optimistic at the OBR on productivity is that we do attach some weight to AI and its ability to be rolled out across the service sector in the UK, and we are now a predominantly service sector economy. So it's not as if those OBR predictions are because we are completely negative on AI. But I think my main point is that economists, simply don't have particularly good models of where productivity growth is likely to be in the future. Now, we could return to the 100-year average over the next 50 years, in which case the fiscal problem really will be a lot less serious than it looks today. But that's not really a policy, that's a hope.
Well, it's always good to have hope. Although they always say
that's true.
Hope is the thing that really kills you. Looking then at the next few years, and some of the choices that are going to face a new government, some people will look back and say, look, we've spent decades and decades thinking about fiscal situation, and then we had the financial crisis and the debt rose by whatever it was, 30% of national income, and then we had COVID and debt rose by another 20% of national income. We could do it then. You could argue that, look at the state of everything in the UK at the moment. It's a bit of a crisis. One-off, to deal with that, I'm the new Chancellor. OBR, look, I'm going to, you can see there's a big problem here. I'm going to borrow some more over the next 5 years to really just get us over this hump, make public services better, invest in staff, and then I'll put us onto a sustainable fiscal path where debt might be 110% of national income. That's quite an attractive argument to a new Chancellor. What's wrong with it?
Well, there may not be much wrong with this at all. I think it does come down to, again, the likely return in terms of higher GDP and higher tax revenue that would make the investment pay for itself at interest rates that are a fair bit higher than they were just a few years ago. And if there are some clear types of public sector spending, capital spending, that are likely to yield a high rate of return, and that rate of return is significantly in excess of the likely interest cost on the debt, a debt which you would have to sell in the financial markets at whatever price made people buy it. If all that were true, then indeed, there's an argument for doing it.
But you're talking very much about a return on an investment. So if I was to say, actually, I'm not talking about that. I'm talking about, making poor people a little bit better off, making pensioners a bit better off, maybe spending some stuff on the justice system, all which might have an economic return. But that's not why I'm doing it. That would be different.
I think that there are forms of government spending that meet the expectations and demands of people and might make people feel better off, but don't generate any higher tax revenues at any point in the foreseeable future, and add to debt without increasing the ability to finance that debt. And whilst there's no denying that there's a great demand for those extra forms of government spending, I think when you start with the stock of debt at 100% of GDP and take it higher, you have to ask questions about how is one then going to fund it at interest rates which, as we've said a few times, are materially higher than they were just a few years ago. That's not to say it's not possible. If one were willing to see the tax takeout of GDP go higher, or one's optimism that interest rates would come down turns out to be fulfilled, then that's fine.
That's and I guess the issue here is the credibility of, is it just a one-off? Then I'm going to sustain things. So let's end by talking about these strange things that you refer to as the markets. Will players in the markets keep buying this? How much are they going to demand in terms of interest? How much difference does what government does make to that? Now, we had the sort of great moment of the mini budget and the big increases in interest rates that were demanded at that point, which some people have taken as a sign that maybe we're up against the limit at which interest rates will start to rise. Others have said this was an extraordinary situation. Actually, if we borrowed another few tens of billions now, that's not the same sort of thing if you've got a kind of credible government doing it. I mean, to what extent in all of this are the markets a real constraint? To what extent are they a sort of boogeyman behind which fiscal conservatives hide?
Well, the fact is you've got to sell the debt to somebody, and one can have all kinds of views on the markets, but unless you force people to buy government debt and finance,
and that has happened in history.
Oh, sure. No. You could do all kinds of things. I mean, you could become a command economy. You could insist that all savings by people in the country should be in the form of government debt. So you could do those kind of things. You could call it fiscal repression, or you could call it a sort of liberation of funds for the best purposes of the state. You could give it many different names. So you could do that. But let's suppose that you don't do that, and you have to sell debt to people who willingly buy it at a price that they find attractive. And that's what we've done for quite a long time in the UK, and lots of other countries have found that's not a bad way to do things, or the least bad way to do things. And if that's how the game's going to be played, then you could call it at the mercy of the markets, or you could say that's the price you have to pay for individual savers to want to have part of their portfolio in the form of government debt. So you can describe it in lots of different ways. What's difficult, of course, is that you can't predict in advance quite where the market price that clears the market, so that the debt that the government issues on a particular day actually finds people turning up and wanting to buy it. And I come back to what happened to the yield on index-linked bonds. A few years ago, people were willing to buy debt with a real interest rate and lend money to the UK government for the long term at an annual interest rate of minus 3% in real terms, and see much of its value wiped out between now and when it was eventually repaid. Nobody was forcing them to do that. There were no guns held to people's heads. That's the price they thought was reasonable to willingly buy the stuff.
We could get into the question of whether that's because of regulation on occupational pension funds.
Well, we could, and I think the short answer to that would be no, it isn't.
Great, well, that's useful for me to know.
Or wasn't, rather. And that price then changed in a relatively short period of time and increased by 3.5%, which on the total stock of UK government debt, as we said earlier, is something like £80 billion more on the bill once it's played its way out over time. And nobody forecast that would happen, and it did happen. And you could say, oh, well, it's not going to happen again, and it might not happen again. You wouldn't need to. It might happen again. You wouldn't need to worry about that much anyway if the stock of debt to GDP were 10% or was 20% or even 30 or 40%. You've got to worry about it quite a lot more when the stock of debt is 100%.
Well, I think that answers the question very nicely. I think what I take from this is that rather as I came into it, which is there are considerable reasons for concern here. We can't forecast the future with any certainty. Things might turn out better than we're hoping, but actually a lot of the forecasts that we at the IFS base what we do on is from the OBR, and the OBR is actually relatively optimistic compared with a lot of forecasters. Even on those relatively optimistic forecasts, the level of debt that we've got at the moment looks worrying, partly because on unchanged policies, it's just going to keep increasing. There is a case for investing for the future, but that doesn't get us round the fundamental fiscal constraints that we have. Recently, it's interesting, Martin Wolf was writing in the Financial Times using the aphorism that if something can't go up forever, it won't go up forever. And I think we can certainly take that as true of UK government debt. At some point, it's going to stop. And if it stops in a crisis, then we're all going to pay a very big price for that, as we began to do after the mini budget of a couple of years ago. So this is something that's going to act as a real constraint on whoever forms the new government. What we've done here suggests it may be in some ways ex ante a bigger constraint than it has been for most governments over the last many decades, because we start with a high level of debt, a high level of debt interest, and a low level of growth. Those three things together are a pretty nasty combination when it comes to making economic and fiscal policy. So I'm afraid that's where we're going to leave you, on that slightly gloomy note, even though I've been speaking to one of the most cheerful economists in the country, David Miles. So thank you so much, David, for coming in and sharing your good cheer with us. Thank you, everyone, for listening to this episode of the IFS Zooms In. To see more of our work, do visit www.ifs.org.uk. And to further support us, and please do in this election year, please do consider becoming a member of the IFS for as little as £10 a month. You can find out more in the episode description. We'll see you next time.